I'm Matt Bishard in San Francisco for NAREIT's REIT World, our 2018 annual conference. Joining me today is Danny Ismail, office analyst with Green Street Advisors. Danny, thanks so much for joining us.
Thank you for having me.
Now, Green Street's projecting a weak return expectations for the office sector. Can you explain what's driving your outlook?
Sure. So one of the best ways to look at Green Street's outlook for office returns in the future is by breaking it down into a few components. What are you paying for the assets? What are you paying to maintain the asset? And what kind of growth can you expect? Now, in the office sector, you're generally paying a pretty low nominal cap rates for an office asset, so your starting initial yield is generally pretty skinny. On top of that, the capex needed to maintain an office asset is pretty high. So Green Street looks at the true cost of property ownership over time. So in the office sector, that includes tenant concessions as well as regular maintenance costs. From that perspective, office is a pretty tough business. Green Street believes that the capex load in the office sector is among the highest in its property universe. And third is that the growth rate in office fundamentals across the country looks generally uninspiring. Rent growth in aggregate looks pretty tough, particularly when you factor in rising concessions. So you roll that all together, low initial yields, high capex, and a pretty weak return, or excuse me, a pretty weak fundamental growth outlook, and you get a pretty weak return outlook for the office sector.
And more specifically, what are you seeing in the public market in terms of the office space?
So the public market is and has been saying for years that private market office values are simply too high. Public market investors are seeing these low initial cap rates in most gateway markets and saying no thanks. So on average, your office REITs trade around a 20% discount to net asset value. So essentially, your public market investors are saying you need these large discounts to underlying private market values in order to produce a return that's comparable to their other options. However, in Green Street's math, even with those large discounts, the office sector and office sector REITs still screen fairly expensive.
Now, so far you've shared a pretty broad perspective on the office sector nationally. What bright spots are you seeing at the market level?
So the tech sector continues to be a bright spot for the office sector. So here in San Francisco, the amount of tech companies that still want to locate in the city of San Francisco continues to be high. I'd point to Facebook and earlier this year their decision to sign one of the largest leases in the city's history at Park Tower as an indication of the need for tech companies to be located next to talent and as well as retain talent. So cities like San Francisco, obviously, but as well as West LA and Seattle continue to benefit from the overwhelming demand by the tech sector. However, there are other bright spots in the sector as well. So the Sun Belt continues to screen healthy as well. The combination of good demand growth, good demographics, better cost of living, lower taxes, as well as corporate relocations continue to benefit cities like Austin, Nashville, and Atlanta. I'd point to AllianceBernstein's decision earlier this year to relocate from New York City to Nashville as some of the positive tailwinds you can get for some of these markets. And third, life science continues to be a bright spot for the sector as well. So life sector cluster markets like Cambridge, South San Francisco, and San Diego continue to see fairly robust demand from life science companies and support some of the best fundamentals in the country.
And one of the challenges in the office sector is capital expenditure pressure on landlords. Can you elaborate on the rising capex burdens that companies are facing?
So Green Street's perspective on capex is essentially what is the true cost of property ownership? What do you need to put into a property in order to keep it competitive over the long term? And in the office sector, as I mentioned, that relates to tenant concessions as well as regular maintenance costs. Both have been elevated this cycle and both show little signs of retreating. So if you look at the public market data as well as the private market data, both point to higher concession costs as well as higher maintenance costs. All this and there are a variety of factors that play into this, changing tenant preferences, densification, really squeezing more people into the same amount of space, as well as the competitive pressures from co-working companies have all pointed to higher capex burdens in the office sector this cycle.
And lastly, you mentioned co-working, and that's what I want to end on. Let's dive a little deeper there, because obviously it is a hot topic in the office space. How does Green Street view co-working's impact on the office sector to date, and what will its overall impact be moving forward?
So co-working companies have obviously had a lot of success in the past few years. I'd point to WeWork not existing 10 years ago and now being the largest private tenant in Manhattan. And some statistics point to around 1/3 to 1/4 of overall net absorption in major gateway cities being related to co-working or co-working-like companies. So while this is great for the co-working operators and their valuations, for traditional office landlords, you now have to compete with this new offering. So these co-working operators generally run denser configurations. As I mentioned, you pack people into a tighter space, and that's generally negative for office returns. They also tend to run highly amenitized space, as well as offer tenants really flexible lease terms. So all this points to you now have to compete with this new product, which will likely translate into higher CapEx and to lower expected returns for the office sector as a whole.
Danny, thank you so much for joining us.
Thank you for having me.
For more from REIT World 2018, be sure to visit NAREIT's website, REIT.com.